If you're chasing reliable monthly income from bonds, but want exposure to the fast-growing economies of Asia, the Crane Shares Asia Pacific High Income USD Bond ETF might look tempting on the surface with its headline yield near 8%. Yet the story gets far more interesting once you see how the net asset value has slid from the launch price of $38.96 all the way down to $24.12 today. This is not another plain bond fund quietly collecting coupons. It layers an options income engine on top of high-yield Asia-Pacific debt, and that combination creates both the fat distributions and the capital erosion that has left long-term holders with a distribution-inclusive return of -5% since inception. Stick around while we open the hood and see exactly what is driving the payout and what it costs you in the process. Crane Shares launched this actively managed fund on June 26, 2018, under the ticker KHYB. It sits in the emerging markets bond category and focuses on high-yield fixed income from the Asia-Pacific region, all denominated in US dollars, so currency translation does not hit the share price directly. The official mandate is broad exposure to primarily high-yield bonds from that part of the world, with an expense ratio of 0.69% and monthly distributions. Assets under management stand at just $16 million, which tells you this is a niche offering rather than a giant institutional vehicle. Because it is actively run, the managers can shift the bond mix as credit conditions change across China, India, Indonesia, South Korea, and the rest of the region. But they also overlay an options income strategy that is the real engine behind the large cash payouts. That dual approach is what separates KHYB from a plain vanilla emerging markets bond ETF and is exactly why its behavior since launch has been so distinctive. This video is for educational and research purposes only. It is not financial, investment, tax, or legal advice and should not be taken as a recommendation to buy, sell, or hold any security. Exchange-traded funds can and do lose value. Distributions are never guaranteed, and past performance does not predict future results. Always read the current prospectus and fact sheet yourself, and consult a qualified professional before making any investment decision. As of July 10, 2026, the fund trades at a net asset value of $24.12 with $16 million in total assets. The expense ratio of 0.69% is on the higher side for a bond product, which matters because every basis point comes out of the income stream before it reaches shareholders. Monthly pay frequency is convenient for anyone building a cash flow plan, yet the small asset base means lower trading liquidity and potentially wider bid-ask spreads than you would see in a multi-billion-dollar fund. The launch reference price back in 2018 was $38.96. So the current level already signals meaningful price movement even before we layer in distributions. These headline figures give you the quick lay of the land, but they do not yet explain how the fund actually manufactures its income or why the net asset value has traveled the path it has. The headline distribution yield sits at 8%, while the mechanical annualized figure, based on the latest payment, reaches 10%. That latest monthly distribution came in at 19 cents per share. The first 4 distributions averaged 17 cents, and the most recent 4 have averaged 19 cents, showing the payout has moved higher over time rather than drifting lower. For an income investor, the difference between 8 and 10% matters because it highlights how sensitive the yield calculation is to the most recent payment size. A single larger distribution can lift the annualized number noticeably, yet it also raises the question of whether that level is sustainable or partly supported by returning capital to shareholders. The higher recent average suggests the options income layer is currently generating solid premium, but the gap between headline and mechanical yield is a reminder that these figures are snapshots, not promises. When you are relying on the cash for living expenses or portfolio rebalancing, understanding that the 19-cent check can flex with market conditions becomes essential. Distribution amounts have risen compared with the early period after launch. The first 4 payments averaged 17 cents, while the latest 4 sit at 19 cents, indicating the income engine has strengthened rather than faded. Over an 8-year span, that upward drift is meaningful because many income products see payouts compress when interest rates or credit spreads move against them. Here the managers appear to have maintained or even expanded the options overlay as the underlying bond portfolio evolved. That trend matters for anyone modeling future cash flows because it shows the distribution is not locked at the original level. At the same time, an upward trend in payouts does not automatically mean the net asset value is protected. The cash leaving the fund each month still has to be funded either by earnings, option premium, or principal, and the history of those monthly checks tells only part of the story. The net asset value began at the launch reference price of $38.96 and now sits at $24.12, producing a negative 38% return on the price alone. The maximum drawdown reached negative 41% at its worst point, meaning the fund experienced an even deeper dip before any recovery. That path reflects the combined pressure of rising U.S. interest rates after 2022, widening credit spreads on Asian high-yield issuers during regional stress events, and the natural drag from an options income overlay that can limit participation in strong bond rallies. Because the fund is actively managed, the managers could have adjusted duration or credit quality along the way, yet the net result is still a substantial decline in the underlying value per share. For a bond fund that is supposed to provide income with relative stability, watching nearly 2/5 of the net asset value disappear is a stark reminder that high-yield emerging markets debt carries real price risk even when denominated in U.S. dollars. When you add the $12.89 in cash distributions paid out since launch to the negative 38% net asset value change, the simple distribution-inclusive return lands at negative 5%. That figure is the closest approximation we have to what an investor who bought at launch and reinvested nothing would have experienced in total wealth. The gap between the raw net asset value decline and the milder distribution-inclusive result shows how much of the original capital has been returned through those monthly checks. Yet it also underscores the core trade-off. The income has offset most, but not all of the capital loss. Compared with simply holding a broad basket of U.S. Treasuries or investment-grade bonds over the same period, the outcome looks different, and it highlights why total return math matters more than yield quotes alone when evaluating an income vehicle. KHYB owns a portfolio of high-yield bonds issued across the Asia-Pacific region and then overlays an options income strategy that sells call options or uses structured notes to collect premium. The managers take the cash flows from those bonds and add the option premium to create the large monthly distributions. Because the options are written against the bond holdings or related indices, the fund caps some of the upside when Asian credit markets rally sharply. If the underlying bonds rise in price, the calls get exercised or the structured notes limit further gains, so the net asset value does not capture the full move. On the downside, the same structure can amplify losses because the premium collected is rarely enough to offset a broad sell-off in emerging markets debt. In addition, when the option premium and bond income together fall short of the targeted distribution, part of the 19-cent monthly check can represent a return of investor capital rather than true earnings. That return of capital component directly reduces the net asset value over time, which is exactly what produced the 38% decline since the $38.96 launch price. The strategy is therefore a classic income now, capital later exchange. You receive steady cash in exchange for giving up some upside and accepting the possibility that the share price will grind lower as distributions eat into principal. Active management lets the team adjust the bond mix and the options overlay as spreads and volatility change, but the fundamental mechanism remains the same. This is not a simple buy-and-hold bond fund. It is a bond portfolio running a side business of selling options, and that side business is what drives both the attractive yield and the observed erosion in net asset value. Going forward, watch whether the latest 19-cent distribution level holds or begins to slip as Asian credit conditions evolve. Track the net asset value trend closely because any sustained stabilization above the current $24.12 level would signal that the options overlay is no longer outpacing the underlying bond performance. Monitor assets under management for signs of meaningful inflows or continued stagnation at $16 million, since a very small fund can face closure risk if flows do not improve. Pay attention to U.S. interest rate policy and how it affects emerging market spreads, because higher for longer rates tend to pressure high-yield issuers in the region. Geopolitical developments involving China, trade tensions, or regulatory shifts can quickly widen credit spreads and test the active management approach. Finally, compare the ongoing distribution trend against the expense ratio drag of 0.69% to see whether the net payout remains competitive with lower-cost alternatives that do not use options overlays. KHYB delivers a genuinely high monthly cash flow by combining Asia-Pacific high-yield bonds with an active options income overlay. Yet the 8-year record shows that most of that income has come at the direct expense of net asset value. The fund has returned nearly $13 per share in distributions, while the price itself fell 38%, leaving investors with a modest overall loss once everything is counted. That outcome is the predictable result of an income-first design that prioritizes premium collection over capital preservation. For someone who needs the cash flow today and is comfortable with the risk of further price declines, the structure can make sense as a satellite holding. For anyone whose primary goal is to maintain or grow principal while collecting income, the same mechanics create a headwind that has already proven difficult to overcome. The choice ultimately comes down to whether the 8 to 10% distribution stream is worth accepting the capital path that has accompanied it so far. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.